Welcome to the Deep Dive. We're here to, well, shine a light on those tricky topics, make the complicated stuff a bit clearer. Today, we're wading into the, let's say, murky waters of work travel and your tax home. And it's like trying to figure out if that suitcase you packed is just for the weekend or if you're maybe secretly moving in. Because the IRS, well, they have some pretty strong opinions, and your deductions really hang in the balance. Our mission today, to boil down the official guidance into something practical, actionable insights you can actually use. We're going to look at how just one, maybe misunderstood IRS rule could completely change your travel deductions. And honestly, it could leave you out of pocket when you thought you were totally covered. You'll hear some surprising facts, definitely, like why your initial thoughts about a job matter even more than how long you actually work there. We'll try to keep it light enough, too. Avoid any tax-induced headaches, hopefully. Okay, let's unpack this then. When you're working away from your main base, your home base, how on earth do you know if you can actually deduct those travel expenses? Lodging, meals, getting there.
That is exactly the core question, isn't it? And it really all hinges on one fundamental distinction. Is your assignment seen as temporary, or is it indefinite? And look, this isn't just playing with words. It's genuinely the difference between, saving potentially a lot on taxes or paying out of pocket for things that absolutely feel like work costs. So to really get a handle on this, we first have to define what the IRS means by your tax home. It's such a crucial starting point because whether your assignment is temporary or indefinite, well, it all depends on whether that assignment changes your tax home. And here's the kicker. Your tax home isn't automatically where your family lives or, where you get your mail. Instead, the IRS defines it as your main place of work, regardless of where your personal home actually is. So just as an example, say you live in Seattle, but you commute every day to Tacoma for your main job. Tacoma, that's your tax home. Got it. It's your workplace, not your bedroom.
Okay. So tax home equals main workplace, literally where the work gets done. Got it. Now, with that base established, how does this whole temporary versus indefinite thing play out? Especially with this one-year rule I keep hearing mentioned. That seems pretty central.
Excellent question. Yeah, once we understand the tax home concept, that one-year rule actually makes a lot more sense. So a temporary assignment, in IRS terms, is one that you genuinely believe right at the beginning is going to last for 1 year or less. And critically, it does in fact last for 1 year or less. If your assignment fits that description, your tax home does not change. You're still based where you were before. So you're considered away from home for that whole time. And yes, you can deduct your qualifying travel expenses. Think of it like a really long business trip. You're visiting, basically, not relocating. Now, on the flip side, you've got an indefinite assignment. This is one where, from the very start, you realistically expected it to last for more than 1 year. And here's the part that often surprises people, the really critical bit. This applies whether or not it actually ends up lasting more than 1 year. So the plain truth is, if the plan, the realistic expectation is for you to be there over a year, the IRS essentially sees you as having moved your work base, even if you never physically pack up your original home. If it falls into this indefinite category, the location of that assignment, that becomes your new tax home. And if that's your new tax home, well, you cannot deduct travel expenses while you're working there. Because it's not travel anymore, right? It's just living and working at your new main job location. The IRS basically says, welcome home to your new tax home. No travel deductions here.
Okay, hold on. That phrase, realistically expected, just kind of tripped me up there. I mean, I always figured it was about the actual time, clocking in, clocking out, the duration you were actually there.
Yeah.
So you're telling me my initial guess or my expectation holds more weight than the actual calendar days?
Uh-huh.
That's genuinely surprising. It almost sounds like the IRS is more interested in my crystal ball than my timesheet.
Huh. You've put your finger right on the nuance that trips up so many taxpayers. It really does. That initial assessment, your genuine belief at the outset, is absolutely paramount. When we say realistically expected, the IRS means, what would a reasonable person, looking at all the facts and circumstances right at the very beginning of the assignment, what would they have genuinely believed? It's not just being optimistic. It has to be a justifiable expectation based on the info you had when you started. And that initial realistic expectation, it directly impacts your tax home status. And consequently, your ability to claim those travel deductions. It really hammers home how important it is to think ahead, maybe even document why you expected a certain duration.
Right. It's one thing to hear the definitions, the rules, but it's totally another to see how they actually work in real life. So to make this crystal clear, let's walk through some specific examples. Help everyone listening avoid those nasty, oops, I thought I could deduct that moments down the line.
Absolutely. Examples make it much clearer. Let's start with a fairly straightforward case. Imagine a construction worker. lives and normally works in Los Angeles. That's clearly their tax home. But maybe work is slow there, so they take a job on a construction project up in Fresno. Now, this worker genuinely, realistically, expects the Fresno job to last, say, 8 months. As it happens, the project runs a bit long and it actually lasts 10 months. Okay, in this scenario, the job is considered temporary. Why? Because it was reasonably expected to be less than a year, and it did in fact last less than a year. Both conditions met. So Los Angeles remains the worker's tax home, and yes, they can deduct their qualifying travel expenses for those 10 months in Fresno.
Okay, that makes sense. Expected less, lasted less, even if a bit longer than planned. Temporary. Deductible. Follow you there. But what if? What if the opposite happens? Like, I go into a job and I genuinely expect it to be a long-term thing. A permanent move? Maybe. Definitely thinking over a year. But then, poof, project gets canceled, funding pulled, whatever, it's done in 6 months. Does that initial long-term expectation still control things, even though reality turned out to be short-term?
That's such an important what if. And yeah, it really highlights the power, the weight of that initial expectation. Let's use our same construction worker. Takes the job in Fresno. But this time, they realistically expect the work to last 18 months. It's a big project, seems solid, a definite long-term gig in their mind. However, unforeseen circumstances. Maybe a budget cut. Maybe the project scope changes. It actually wraps up in only 10 months. In this instance, the job is still considered indefinite, right from the very beginning. Even though it lasted less than a year, the initial realistic expectation was for it to be over a year. Therefore, Fresno becomes the worker's new tax home from day one. And unfortunately, they cannot deduct any travel expenses they had while working there during those 10 months. It can feel unfair, I know, but that initial reasonable anticipation carries huge weight with the IRS.
Wow. Okay. So it truly, truly is all about that initial thought process, what you could reasonably see happening at the start. It's less about the actual time elapsed and much more about the planned duration, the expected duration. So the IRS is basically asking us to be fortune tellers, but realistic fortune tellers.
Precisely. Realistic fortune tellers, I like that. Now, let's make it a little more complex, because, real life rarely fits neatly into boxes. What if an assignment starts out clearly temporary, but then it stretches out unexpectedly? Take our construction worker again. They expect the Fresno job to last 9 months. Okay, clearly temporary, deductions are happening, they work for 8 months, everything's going according to the initial plan, travel expenses are being deducted, but then their employer comes to them and says, hey, we need you to stay on. We've got another 7 months of work for you here.
Yep.
So now the total actual stay is going to be 15 months, 8 plus 7. Okay, in this situation, the job was initially temporary, no question. So the worker can deduct travel expenses for those first 8 months. However, because of the changed circumstances after those 8 months specifically, the request to stay longer, making the total expected stay over a year, it's no longer realistic to expect the job to last 1 year or less from that point forward. So at that 8-month mark, the nature of the assignment shifts. It becomes indefinite. Fresno then becomes the new tax home from that point. And the worker cannot deduct any travel expenses for the period after that change. So for the last 7 months of their assignment, no deductions.
Okay. So the timing of that shift, when the expectation changes, that's absolutely critical. It's not retroactive, wiping out the early deductions. It's a change going forward from the point circumstances shift. This is really getting into the nitty-gritty of when you knew or when you should have known the expectation changed. What about, say, a series of short assignments? Back-to-back maybe, or with short breaks, but all in the same location. Could those get added up somehow and be seen as indefinite, even if each individual one is like 3 months? Seems like a potential loophole the IRS would watch.
You're absolutely right to think about that. The IRS is definitely wise to that. The rules are pretty clear. Yes, a series of short assignments in the same location, even if each one on its own is brief. If, taken together, they cover a long period, or if it looks like you're basically just breaking up a long-term job, they may indeed be considered an indefinite assignment overall. The IRS looks at the bigger picture, substance over form. And speaking of initial expectations and long-term intent, there's also something called the probationary work period rule. This comes up if you take a job that requires you to move, right? And there's an understanding that you'll keep the job permanently if your work is satisfactory during some initial probationary period. In that case, the job is considered indefinite right from the start, from day one. You can't deduct any expenses for meals and lodging during that probation period because the intent, the expectation for long-term employment is there from the beginning. Even with the probation condition, you're essentially committing to the move.
Right. The underlying assumption is permanency, even with the trial run. Okay. Okay, so we've spent a lot of time figuring out when an assignment is temporary versus indefinite. Now, for those lucky listeners whose assignment is temporary, what exactly can they deduct? We touched on travel, lodging, meals. Are we talking flights, hotels, that fancy coffee on the way to the work site? What's generally allowable?
Right, good question. When you are genuinely away from home on a temporary assignment, the scope of deductible expenses can be pretty significant. It definitely includes the cost of travel to the temporary location back home. So, yes, airfare, train tickets. Or if you use your own car, you can deduct the standard mileage rate or actual expenses. Then there's lodging or hotel costs, or maybe a short-term rental apartment. That's deductible. Meals are also deductible, but usually subject to a 50% limit, so you can deduct half the cost of your meals while away. You can also potentially claim incidental expenses, things like laundry and dry cleaning if needed for work, local transportation at the temporary site like bus fare or taxis between your hotel and the work site, even things like business phone calls or internet access charges if they're necessary for your job while you're away. The key phrase the IRS uses is ordinary and necessary expenses. They have to be reasonable and directly related to your work while away from your tax home because the assignment is temporary. And of course, the absolute golden rule: keep meticulous records, receipts, dates, locations, the business purpose for every expense. You need that proof.
Fantastic. That's really helpful detail. Meticulous records. Got it. Makes sense. This does raise another important question, though. Beyond just temporary versus indefinite, what about other related things? Like, what if my employer gives me money specifically for relocation? Or what happens tax-wise those times I decide to go home on my days off from a temporary assignment? Are there any specific rules or traps we need to be aware of there?
Yeah, those are excellent follow-up points. Very common situations. First, if your assignment is deemed indefinite, meaning that location is now your tax home, then any money you get from your employer for living expenses, even if they call it a travel allowance or a per diem, it generally has to be included in your gross income. It's taxable. Why? Because you're not technically traveling for tax purposes anymore. You're living and working at your tax home. So that money is just considered compensation. Now, regarding moving expenses, this is important and relatively recent. For most taxpayers, basically, anyone who isn't active military moving due to orders, the deduction for moving expenses is currently suspended. This suspension is in effect for tax years starting after December 2017 and running through the end of 2025. So for the vast majority of people right now, unfortunately, you can't deduct those costs of physically moving your household goods and things like that. But, speaking of exceptions and unique situations, there is a really specific carve out from this whole 1 year rule framework. It applies only to certain federal employees. It's quite niche, but interesting. If you're a federal employee, like an investigator or prosecutor, involved in a federal crime investigation or prosecution away from your main post, you might get a special pass. Under very strict conditions requiring certification by the Attorney General or their designee, you can actually be exempt from the 1 year rule. This means you could potentially deduct travel expenses, even on assignments lasting longer than a year. It just shows the layers of complexity in tax law, right? But for most folks listening, that standard 1 year rule is definitely the one to focus on.
That is truly fascinating, a very specific exception indeed. Okay, but let's bring it back to something maybe more common for our listeners. Going home on days off. You're on a temporary assignment, say for 6 months. It's Friday, you want to go home for the weekend. Can you deduct anything for that trip back home? The travel, meals while you're home. This must happen constantly.
Right, yeah, the going home on days off scenario. Very common. Here's the simplest way to think about it. While you are physically at your tax home, your regular home base, you are not considered away from home. So during the time you spend at home on those days off, you cannot deduct costs for meals or lodging there. That makes sense, right? You're home. But, and this is the useful part, you can deduct the cost of traveling between your temporary work location and your tax home. So the round trip travel costs, flight, train, mileage, are potentially deductible. There's a catch, though. Or rather, a limit. The IRS doesn't want you spending, say, a fortune on first-class flights home every weekend if it would have been cheaper just to stay put. So the amount you can deduct for that round trip home, including any meals and lodging during the travel itself, is limited. It's capped at the amount it would have cost you to simply stay at your temporary work location for that period. Primarily what you would have spent on meals and lodging had you not gone home. Oh, and a neat little related point. If you decide to go home for the weekend, but you keep your hotel room or temporary apartment at the work site, you can still deduct the cost of that lodging while you're gone. The thinking is, well, you had to pay for it anyway to keep your place for the temporary job, whether you slept there that weekend or not.
Okay, that makes sense. Deduct the travel home up to the cost of staying put, and keeping the hotel room is still deductible. Good practical tips there. So let's pull this all together. What does this really mean for you, the listener, as you're planning your work, maybe considering an out-of-town assignment, managing your finances? This feels like, it feels like a lot of crucial details to keep track of. And frankly, maybe a bit of a minefield if you get it wrong.
It definitely can feel that way, but hopefully we've cleared some of the fog. I think the absolute biggest takeaway is the critical role of your initial realistic expectation about how long an assignment will last. Remember, it's often not just about the actual time you end up spending there, but your genuine, reasonable belief at the outset. That's what primarily determines if it's temporary or indefinite. And this also means your tax home isn't some fixed address carved in stone forever. It's actually quite fluid. It can change based on these expectations and even shift mid-assignment if circumstances change significantly. So the core message here really has to be proactive, be thoughtful. Right from the very start of any assignment away from your main workplace, take a moment. Evaluate your expectations honestly. Document why you expect it to last a certain duration, especially if it's close to that 1-year mark. Keep really good records of everything. That foresight, that documentation, it can literally be the difference between claiming significant tax savings and facing a very unwelcome, unexpected tax bill later on. Don't leave it to guesswork.
That really is the aha moment, isn't it? That surprising yet incredibly powerful weight the IRS gives your expectation over the actual duration. It completely reframes how you should think about planning for work travel and managing those potential deductions. It's about foresight. So we've taken quite a deep dive today into decoding your work travel and your tax home. We covered that critical 1-year rule, walked through real-world scenarios, touched on some special cases, understanding these distinctions, temporary versus indefinite, expectation versus reality, is just invaluable for smart financial planning if you work away from home. Here's a final thought to leave you with. Just consider how a simple shift in your expectation about a work assignment, even if things don't actually pan out exactly as planned, how that initial thought could fundamentally change your financial picture from a tax perspective. It really highlights that it's not just about where you unpack your bags physically, it's also about the story, the realistic story you're ready to tell the IRS, about how long you genuinely expected to stay there from the beginning. Thank you so much for joining us on this deep dive.
We hope it was helpful, and we look forward to exploring more fascinating topics